One way to incorporate quantitative strategies into a traditional advisory portfolio is to adopt the core satellite approach. The quantitative strategies can form the core part of the portfolio since they have objective rules for dynamic asset allocation, as well as entry and exit signals for individual trades. They also have objective historical statistics for you to determine whether the strategies are behaving as they should. So this makes running the quantitative strategies relatively easy and hands-free. Now, then the advisor or the client can free up their time to look at thematic ideas that they want to include into the satellite portion of the portfolio. So if the quantitative strategies perform as expected, the core part of the portfolio should be able to deliver stable, risk-adjusted returns, while the thematic returns could be a little bit more volatile. So in this way, even if the thematic ideas do not work out, the overall portfolio should still be okay. Now, if the thematic ideas work out fantastically well, this can be a bonus on top of the core portion of the portfolio. In the past, most quantitative strategies can only be implemented using either futures or swaps that are available through banks. Such instruments are typically not accessible to retail investors because they either require a more sophisticated knowledge or they require a certain minimum size before the banks are willing to deal with you. So this is the reason why in the past, only institutional investors with the sufficient resources can run quantitative strategies. But with the development of the ETF markets, a lot of new ETFs are being issued that gives access to alternative asset classes like your bonds and your commodities. And these ETFs are bought and sold just like stocks on any stock exchange. And in fact, in the US, there are also ETFs that allows you to track things like the S&P 500 implied volatility. So therefore, quantitative strategies can now be implemented using ETFs, which is why retail investors are increasingly able to run quantitative strategies even in that space. Just like any other strategies, including discretionary strategy, the main risk for any quantitative strategy is that the advantage that it is trying to capture in the market is no longer available, right? In other words, the model stopped working. There are some strategies that are more prone to this risk than others. So for example, for those strategies that do risk arbitraging, right? As the opportunity become known by more players, there will be more and more competition coming into the market to try to extract the same advantage out of the market. And because of that, right, the profit potential of that opportunity will get squeezed and it becomes harder and harder to extract that advantage. And over time, you'll find that this advantage can even disappear. Now then, for trend following strategies, right, there is a risk that the market can transition from a trending one into a mean reverting market. Now, under a mean reverting market situation, right, trend following strategies will find themselves getting whipsawed, right? And on the other hand, for mean reversion type strategies, the opposite is true. If the market transitions from a range-bound market into a strongly trending one, then mean reverting strategies could suddenly find themselves losing a lot of money. There are also other less obvious risks for quantitative strategies that has to do with market microstructure. This is especially true for high-frequency trading type of strategies. Now, because for high-frequency trading, right, trading cost is a very important element of the strategy. If in live operation, right, the trading cost turns out to be higher than what has been modeled into the backtest, a profitable strategy can become a mediocre one, or if the trading cost is high enough, it can even turn a profitable strategy into a losing one. One of the most underappreciated truths about financial markets is that it is really the market regime that determines the performance of a strategy rather than the skill of the manager. Now, of course, the skill of the manager matters, but sometimes the market regime can actually be construed as the skill of the manager. So it is very important, right, when you want to backtest a quantitative strategy, is to make sure that the strategy backtest period covers a full market cycle so that you're able to see the real performance of the strategy under the different market environments. So let's take two long-only managers. The first is a very aggressive one who likes to take on a lot of leverage in his position. Now, the other manager is more conservative and he doesn't like to take unnecessary leverage. And the market regime is actually an extremely bullish one. And as a result of that, right, the first manager that adopts a lot of leverage actually delivered a lot more returns than the conservative manager. But is this an indication of skill? If the two managers were to maintain their same level of leverage and then the market turns into a bearish one, you'll find that the leverage manager would suddenly lose a lot more money than the more conservative one. So really, the performance is determined by the amount of leverage and not so much because of the skill level. The other important part about developing robust quantitative strategy is that you need to have a sound basis as to why the quantitative strategy is expected to deliver returns when deployed in market. Now, the reason is because any strategy will inevitably run into a tough patch when the market environment is not favorable. And when this happens, right, if your model is based on something that has a sound basis, you can then investigate and find out whether is it a case that the advantage that you're trying to extract from the market is no longer there permanently because of changes in the market dynamics, or is it just a transitory feature of a market phase that will eventually pass? So if let's say it is the latter situation, then the decision can well be just to ride out this transitory phase in the market before the markets turn around and the model starts to work again. You're not able to make this kind of decision if your quantitative model is simply based on pattern recognition, so you'll not be able to know whether the model has broken down or not. Quantitative models do underperform from time to time. Okay, this is because market regimes change, and as well as ad hoc events can come along that temporarily affect the performance of the quantitative strategy. However, this does not necessarily mean that the model is broken. So the advantage of quantitative strategy is that there are objective historical characteristics that can allow you to determine whether the model has deviated from expected behavior or not. So an example is that historically, if let's say over the backtest period, the maximum drawdown that the model has ever experienced is, say, like, for example, 10%. So then when the actual live drawdown exceeds the 10% threshold, that could be a trigger point for you to review the model. Okay, of course, you can also allow for some buffer because there could very well be environments that wasn't captured in the backtest period. Okay, but that doesn't mean that the model has broken down totally. Another historical characteristic that can be used as a trigger point for review is to monitor the rolling window period of the Sharpe ratio, or what is called the risk-adjusted return of the strategy. So over a longer window period, right, the rolling Sharpe ratio should be relatively stable. So if you notice that as you run the model going forward, this rolling Sharpe ratio starts to deteriorate, it might be an indication that the edge in the model is being eroded away. So that could also trigger a necessary review of the model to see whether the market has changed such that the advantage in the model is increasingly disappearing. Another useful thing to do, right, is to actually compare the live performance of the strategy against the model performance. Okay, this is because there could be certain operational costs or constraint that has not been factored into the model that may render the actual performance of the strategy to be less ideal as compared to what you see on paper. Okay, so if you compare live versus model performance, right, and the live performance actually matches pretty closely to the model performance, then you are reassured that whatever you see on paper can actually be translated into actual returns.